Hello everyone, my name is Vijay, and this is my first ever video made on mutual funds or anything related to investments. Before getting into the topic, I would like to quickly introduce myself. Like most of you, I'm a computer science engineering graduate and I completed my engineering back in 2004. Immediately after my course, I got into a services company in India, and then later I moved to a product based company. And currently I'm working in Bangalore. Um, the reason I wanted to do this video is because, like most of you, I also got into the investment game, especially into financial markets, very, very late in my career. Um, Coming from a very traditional family background, my choice of investments were always used to be fixed deposits, recurring deposits, gold, as well as real estate. But to be very honest, of these four different investments I told you about, only gold gave me returns. And that too, not exorbitant returns comparing to what the market could have given me. And I wanted to share my knowledge on what I have learned, especially in the last 3 to 4 years, once I started to invest in the financial markets. I hope my experience will benefit you. At the same time, I hope the video might inspire you to start getting to the financial market space. Just a disclaimer, like I said, I'm not an investment professional. I'm a software engineer by career. But what I'm going to share is completely based upon my trial and errors. Okay, just one more tip or information before we directly get into the session. A lot of us actually think that, oh, now the Sensex is at 60,000 or 55,000, and it's already very late for me to get into the game. The train have already left the station, and it's too difficult for me to get there. But the reality is, you have never missed the train. If you missed to onboard the train from station number 1, make sure that you catch up the same train or onboard the same train in station number 2. Because no matter in which station you are onboarding, you are going to reach the destination. But the longer you travel, the more benefits you will get. That's a fundamental principle. So my dear friends, don't think that it's too late for you to get into the game. It's never late. And I'm going to teach you in few of the upcoming sessions about how safely you can invest towards a financial goal so that you can slowly grow your corpus towards your financial goals. Now, the first couple of slides or sessions, I'm going to keep it very open to go through some of the basics. And if you think you already have a lot of information about this subject, feel free to skip. In chapter 1, I'm going to talk a little bit about mutual funds and what are my justifications to prove you that why mutual funds are safer way to invest. Why mutual funds are safe? It's because when you are investing in mutual fund, you're not putting all the eggs in one basket. And what happens if you put all the eggs in one basket? If the basket drops, the entire eggs get broken. Maybe one or two will survive. And that is the same principle what a mutual fund follows. Let me get into some of the examples. So let's say you heard about from your friends, colleagues, relatives that investments in the markets are giving them exorbitant returns. You'll get excited, you'll take your friend's advice and start putting your money in the markets. Let's say, because of your excitement, you ended up buying Tata Motors. Tata Motors is, of course, a hot stock in 2021. And you decided to invest, let's say, 1 lakh into Tata Motors. So what happens? Let's say you bought the Tata Motors share at 484 rupees per stock. Now, in a happy path, you bought it for 484, and if it goes to 500, you're going to make a profit. You'll be happy. But the reality is, the markets are not always towards the upward direction. There will be ups and downs. It's like a roller coaster. Now, what if instead of heading towards 500, your 484 rupees Tata Motors is now falling to 450? You're going to make 34 rupees per share. In reality, you are making a loss. Plus, it's not like your friend is right or your colleague is right. Nobody can predict a market. There could be a lot of things happening within the company that might be pulling down the profits. There might be a lot of external factors that might be impacting Tata Motors. For example, let's say Tata Motors decided to invest in electrical vehicles. It's an hypothetical scenario, by the way. Today, the government of India provides a lot of soaps for a consumer who is planning to buy EVs or electrical vehicles. What if the subsequent year or in 2022, as part of the union budget, the government announces that they are no longer going to support subsidies on electrical vehicles. Now, Tata Motors, who have heavily invested in electrical vehicle manufacturing facilities, are not going to utilize their capacity to the full extent because the demand for EV is going to go down because the government have stopped the soaps on EVs, which could negatively impact the revenue which Tata Motors is going to make. Now suddenly, the price of the Tata Motors goes down. And you being an average investor, you being not knowing all the details, you suddenly notice that you are actually making a loss on the stock that you have purchased. The losses are very stressful and demotivating. And believe me or not, once you realize the pinch of the market and if you are an average investor, you will end your investment post that. Now, what makes mutual funds a safer place? Let's take the same example what I told before. You invested your 10,000 or 1 lakh rupees into ABC mutual fund. You tell the company that I need to invest 10,000 or 1 lakh, and you are letting the company to make a decision on where to invest. And that is what mutual fund is. So then the company, instead of investing your money into Tata Motors, they will splitting that money based on some sort of fantastic algorithm or logical reasoning that the portfolio managers come up with. And these investment professionals will split that money and invest proportionally in Tata Motors, let's say Wipro, Bata, and Dabur. Now let's play back the same scenario. Tata Motors goes down from 484 rupees due to the other hypothetical scenario which I told you about. Now the Tata Motors stock goes down, and let's also assume that Wipro was also into EV. Wipro also have some sort of client losses due to some sort of data breach that happened in Wipro, and Wipro stocks are also going down due to some reason. But at the same time, two other companies that your funds have invested in, Bata and Dabur, are going up because there is a high demand for, let's say, shoes in the market. Or let's say Bata got a big export deal with some company in the United States. Or Dabur sees that their products are being sold across India in tenfolds. Since people started to live a healthy life post-pandemic. Now, Bata and Dabur are doing well, but at the same time, Tata and Wipro are not doing so well. Now, what happens to your money? Even though a couple of companies are making a loss, two other companies you have invested in are making a profit. And whatever loss you are making on the other side is getting well balanced by the two other companies you have invested in who are doing well. In this way, the impact on the losses are getting balanced, which is why we say that mutual funds are a safer place to invest. Now, coming back to the egg story, instead of putting all the eggs in one basket, you're basically keeping each egg in its own basket. So that even if the basket falls, only the eggs in that particular basket will break. Like I said, there is always a risk when you invest in market. Nobody can predict how the market will do. A big example is COVID-19. When we all started in 2020, none of us expected that COVID-19 will become a pandemic and we all will sit at home for more than two months. And in reality, we are still into the pandemic and there is no sign of improvement. And when the pandemic was first reported, the markets drastically fell. I still remember the day the Sensex was doing at around 55,000. And in a couple of days, it came closer to 28,000. So the risks are always there. And most of the risk cannot be predicted. Some of them can be predicted. There are many scenarios where you can exactly pinpoint and say that there are risks and these risks can happen or may not happen. But there are always risks like pandemics or natural disasters, right? Those kind of things can anytime happen and those risks cannot be predicted. But diversifying your investments in mutual fund is helping you to mitigate the risk by minimizing the losses that you're going to experience. Now, coming back to the question of, are mutual funds risk-free? Absolutely not. Like I said, markets always goes up and down. But it's the strategy that you formulate that will help you to grow your corpus along with the market. Then why do we still call it safe, right? Because historically, if you look at, the market always outperforms in the long term. A simple example is Sensex. Sensex today is standing at around 60,000. It's an index value. We will get into the details in one of our later sessions. But the number 60,000 is actually an index value, which means at some point in time, the base value was 100. When the Sensex started back in 1980s, it started at 100. And today, it is standing at 60,000, which means if you invested 100 rupees in Sensex, 100 rupees in Sensex, today the value of that 100 rupees is at 60,000. And that's an obvious reason why I say investing in the markets or investing in mutual funds are safe, but the investor should always focus on long term as that horizon. Especially people like me who are into late 30s, early 40s. We don't have a lot of time for us to make up our losses. Whatever mistake you do at 25 or 30s, it's easy for you to make it up. But once you reach your 35s, early 40s, and if you make a loss, you cannot recover from those losses. So people at this age, especially middle-aged men and women, should take calculated risks to grow your corpus. And those are the techniques I would like to discuss in my future sessions. Well, that's all I wanted to convey today. In my next video, I'll be talking more about mutual fund terminologies. It's very important that all of us are very much confident about some of the terms and techniques or terms and terminologies that we use. And the next session, I'm going to focus on coaching you about some of the terminologies that we frequently use in mutual fund investing. Hope you all have enjoyed and liked the video. If you really like it, please like my video and subscribe my YouTube channel. Thank you.